Hey everyone, welcome back to Corporate Decoder, the place where we decode public company secrets. Today we're diving deep into the Rockefeller Municipal opportunities, fund's latest shareholder report, and trust me, some of these municipal bond holdings might surprise you. Are you curious about how this fund is handling interest rate changes and what is really going on in the municipal bond market? Stick around because we're decoding it all. Before we dive in, if you appreciate getting straight insights from these massive financial documents, make sure you are subscribed. Also, we have a growing Discord community linked in the description, where we break down these filings and more. So, the Rockefeller Municipal Opportunities Fund, managed by Rockefeller Asset Management, aims to give investors access to high-yield municipal bonds. They do this through an interval fund structure, which means they offer to buy back a portion of shares periodically, kind of like a way to provide some liquidity. Their main goal is to generate income, and they aim to do that by doing really deep research into the credit quality of these bonds. Think of it like a super smart detective for bonds, looking for the best yield for the risk. Now, the period this report covers from December 2024 through September 2025 was a pretty wild ride in the financial world. We saw the Federal Reserve making a few interest rate cuts, which usually helps the market for things like bonds. But then there was this whole thing with Liberation Day tariffs, which caused a lot of back and forth and uncertainty, making the prices of different bonds jump around quite a bit. Despite all this noise, the fund managed to do pretty well. Let's look at the actual performance numbers we found in the shareholder letter. For the period from when the fund started back in December 2024 through September 2025, the fund itself had a total return of 2.99%. That is actually pretty good when you compare it to its benchmark index, which is a mix of high yield and regular municipal bonds. That benchmark index actually lost 0.07% over the same time. So yeah, Rockefeller's fund actually made money while its benchmark lost a little. That is a real win. Now, let's get to the really juicy part, the schedule of investments. This is where we see exactly what the fund is holding. And wow, there are a lot of municipal bonds here. They've got a significant chunk, 10.9% in California bonds. For example, they're holding a bond from the California Municipal Finance Authority with a 4.00% interest rate maturing in 2050, valued at over $830,000. They also have a substantial holding in Los Angeles Airport revenue bonds, 5.50% maturing in 2055. That is worth over $8.5 million. New York is another big one, making up 13.0% of their holdings. They've got a pretty big stake in the New York City Municipal Water Finance Authority, with a 5.25% bond maturing in 2054, valued at over $8.4 million. And they also have several holdings related to JFK Airport, totaling over $3.5 million in value. But the biggest slice of the pie, a whopping 16.4%, is in Texas. They're holding several city bonds in Texas, including ones from Buda, Granbury, Seguin, and Terrell. For instance, the city of Seguin bond with a 5.50% interest rate maturing in 2059 is valued at over $8.6 million. They also have a large holding in Tarrant County Cultural Education Facilities Finance Corp., bonds totaling over $8.7 million. It is clear this fund is heavily weighted towards specific states and has a lot of exposure to infrastructure and public facility projects. And here is something interesting. They have 26.2% of their assets, which is a substantial amount, in something called floating rate note obligations. These are essentially bonds whose interest payments can change over time, often tied to some benchmark interest rate. They have a face value of $48 million that they've borrowed, which is part of what is called leverage. Looking at the statement of assets and liabilities, we see the total investments are valued at over $231 million. But they also have liabilities, which are basically their debts. They owe over $48 million related to these floating rate note obligations. This means they are definitely using borrowed money to boost their potential returns, which, of course, also increases their risk if things go south. The statement of operations tells us how the fund made and spent money during the reporting period. They earned over $5.9 million in interest income from their bond holdings, but they also had expenses totaling nearly $2 million. After some adjustments and fee waivers, their net investment income, which is what is left after expenses from their investments, was about $4.1 million. They also had realized and unrealized gains on investments, meaning some of their bond holdings increased in value, adding another $1.3 million to their total increase in net assets. The statement of changes in net assets shows how the fund's total value grew. From operations, they added about $5.4 million. They also paid out over $4.3 million in distributions to shareholders. Then there were transactions from shareholders buying and selling shares, which brought in a net increase of over $183 million. All this added up to an increase in net assets of over $184 million. The financial highlights give us a per share view. The net asset value per S-share at the end of September 2025 was $19.92. For the entire period from when it started inception, the total return per S-share was about 2.99%. They also had a pretty high portfolio turnover rate of 221%. That means they were buying and selling a lot of their holdings during that period. It can mean they are actively trying to capture market opportunities, but it also means higher transaction costs. Now, the fund does highlight several risks, and one that stands out is leverage risk. They use leverage which magnifies both gains and losses. It means if the market goes up, they could make more, but if it goes down, they could lose more. They specifically mention using tender option bonds, or TOBs, which is a way of using leverage. Basically, they deposit bonds into a trust, and the trust issues notes to investors and then gives cash back to the fund. This can amplify returns, but it definitely adds a layer of complexity and risk, especially if interest rates fluctuate in certain ways. The notes to financial statements are where the real technical details are explained. When they talk about the floating rate note obligations, they explain how these TOB transactions work. They are essentially secured borrowings. The fund puts municipal bonds into a trust, and that trust issues floating rate notes to investors, pocketing cash for the fund then holds the residual interest, which is riskier but can offer higher returns. They clearly state that for TOB floaters, the interest rate resets periodically and holders can usually tender them back for repurchase. The fund accounts for these TOB transactions as secured borrowings. Outstanding TOB floaters are shown as a liability and the face value approximates their fair value. As of the 30th of September 2025, they had over $68 million in municipal bonds deposited into these trusts, with a liability of over $48 million in TOB floaters. This shows they are actively using this leverage strategy. Under risk considerations, they dive into what could go wrong. They talk about interest rate risk, municipal bond risk, management risk, where the manager might not pick the right investments, market risk, where the whole market could go down, valuation risk for hard to price assets, leverage risk, which we just touched on, diversification risk because they can put a lot of eggs in fewer baskets, liquidity risk, meaning some investments might be hard to sell, and repurchase offer risk since they are an interval fund and offer to buy back shares periodically, which could force them to sell assets at a bad time. On the cost side, the management fee is 0.75% of what they call managed assets. They also voluntarily waived a portion of that fee for a while, which is a nice gesture. They have an expense limitation agreement, meaning they promise to keep overall operating expenses below a certain percentage, 1.50%, through January 2027. If expenses go over, the investment manager eats the cost up to a point. They can also recoup past waived fees within 3 years, provided it doesn't push expenses over the limit. Looking at the leadership, we see 4 independent trustees. P. Bradley Adams, who is a managing director at Tortoseco Fin Investments. Stephen P. Ban, an adjunct professor and former senior advisor, Jeanette L. Lewis, a consultant and former general counsel. And Marie C. Winters, a former senior vice president in corporate credit research. They all joined in October 2024, so they are relatively new to this fund. The officers of the fund are also listed. Benjamin J. Irick is the president, Mark S. Spencer is the treasurer, and Andrew N. Jones is the chief compliance officer. It looks like most of the key officers are from US Bank Global Fund Services, which acts as the administrator and transfer agent for the fund. The primary portfolio managers are Scott Cottier, Mark Demetri, and Michael Camarella. They all have experience in municipal bonds, having worked at firms like Invesco and Oppenheimer funds. They are all CFA charter holders, which means they have a high level of professional qualification in investment management. They are responsible for managing the fund and several other registered investment companies, managing about $233 million in total across these accounts. So, what is the takeaway here? The Rockefeller Municipal Opportunities Fund seems to be effectively navigating a challenging market. They've managed to deliver positive returns while their benchmark index lagged. Their strategy of deep credit research to find yield in the municipal bond space appears to be working. However, the significant use of leverage through floating rate note obligations and tender option bonds is a double-edged sword. While it can boost returns, it also significantly increases the fund's risk profile. A downturn in the municipal bond market or a sharp rise in short-term interest rates could have a magnified negative impact. Their heavy concentration in certain states and specific types of municipal bonds like airport and water authority revenue bonds also presents a risk if those specific sectors or regions face economic trouble. The fact that they are an interval fund means investors should be aware of the limited liquidity. You can't just sell your shares anytime and expect to get your money back immediately like you can with many mutual funds. You have to wait for the periodic repurchase offers. Overall, this fund seems to be performing well for investors willing to take on the risks associated with high-yield municipal bonds and leverage. But it is crucial for potential investors to understand these risks fully, especially the sensitivity to interest rate changes and the limited liquidity. Alright, that is our breakdown of Rockefeller Municipal Opportunities. Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.